Inflation expectations and how people perceive price movements are both interconnected. The perception of value is a very important concept because it will be a driver of price levels on the upside or on the downside. If we take a very simple example, like you hold an old car and you need to change it because it's costing you a lot of money in taxes, in repairs and whatsoever. If you perceive, because you are reading newspapers and news and there is some supply chain disruptions, and if you perceive that the prices will increase in the next couple of months, you might be tempted to purchase your car right now. Conversely, if you have the converse information, so you strongly believe that the prices will go down, you might postpone your purchase to another moment. And these beliefs are somehow, because if one people believes that, 2, 3, 10 people, thousands of people will be self-fulfilling for the economy because demand will drive prices up. If you take Japan, I think it's a very good example of this concept. This country has been subject to 30 years of deflationary pressures for many different factors, of course, like demographics or no wage growth, low economic growth. But all of it led to a kind of subdued consumption among Japanese people. And this very low consumption at the end just reinforced the deflationary pressures in the country. Media coverage and social network play a crucial role nowadays. With the rise of internet, we had a real impact on the consumption behavior. The access to information is not really the problem, but is the quality of information that is given to people. Big headlines, repetition of articles, the quality of information with very simplistic theories that doesn't reflect potentially the reality are increasing the stress of the consumer. I would say that newspapers are not here any longer to inform people, but more to sell the information and the news they have to share. This often leads to an overreaction by market participants because humans are impulsive beings, and of course they want all the most for the less, which is a logical behavior. And if I can link these behaviors maybe with finance, we have also this kind of biases because the information that is provided to investors sometimes leads to overreactions, and they do bad investment choices based on wrong information they receive by the market. Central banks have a key role in maintaining price stability. Their goal is to prevent overreaction, bubbles, dysfunctionalities in the markets. They are not only here to manage inflation expectation, but also somehow the financial markets expectations, because they are strongly correlated and also with the real economy. Their main tool are interest rates, targets, and if you look at over the past couple of months, all central banks across the world have raised very quickly their interest rates. And their goal was to somehow freeze the economic activity and to control the prices increases that we experienced after the COVID pandemic. In doing so, most of them had a very good communication, very transparent in saying their moves, what they expect about the economy, and what the rates would be if the data supported their beliefs. And a contrary example of that was in 2013, for example, with the taper tantrum that took place after the great financial crisis. Most central banks implemented QE programs, and in 2013, given the fact that economic data was pointing to some improvements, they came out in the market saying that they will reduce the purchase of bonds. But they didn't give the pace, neither the amplitude of the reduction. This created a lot of uncertainties among investors, and of course markets overreacted strongly with bond yields rising a lot, equity markets going down, and emerging market currencies depreciating a lot versus dollar. This is a perfect example of bad communication, and I think they learned a lot since then. We often say that financial markets are ahead of real economy by 6 to 12 months, more or less. And we as investors and professionals, we tend to anticipate, predict, to try to build strategies that have a good risk return for our clients. Of course, to do so, we need to have a clear view, not only about inflation numbers, but also about inflation regime we are operating in. And if we succeed in, let's say, analyzing and predict properly next moves from central banks, from markets, and the reactions that might happen, we will succeed in building strategies that are really relevant for clients. Not being able doing so can be really damageable for the performances of our portfolios. So I would say that the main message is to be flexible, to listen to markets, and do not try to overreact.